I'm Avnish Jain. Welcome to this monthly debt outlook from Canara Robeco. Geopolitics continue to plague the world. The two wars, one between Russia and Ukraine, and other in the Middle East between Israel and Palestine, continues unabated. Despite repeated attempts by various countries to impose a ceasefire between these two wars, it has been unsuccessful. Russia continues to defy sanctions and has accelerated the attacks on Ukraine. On the other side, US has come back to supporting Ukraine and has been supplying them with arms to counter Russia offensive. In the Middle East, despite many Western countries, especially European countries, supporting Palestine as a separate state, Israel continues its campaign in Gaza to take over Gaza Strip as their primary objective. In this, they are supported by the US, and because of this, all the UN resolutions by countries fail because the US holds the veto power. While war continues, the world continues to be in a normal mode. When you look at markets, US markets, equity markets are at decades high, and other markets continue to do well. Coming to US, the data in US continues to be contradictory. Despite tariffs imposed by US on various nations since last 6 months, the data in US, especially consumption data, remains strong. Inflation hasn't shown the uptick it was expected to show, though the inflation numbers remain sticky around 2.9% CPI. In other countries, when we look at the European Union, growth there is picking up a bit, but inflation remains under control. Central banks in the Europe, the ECB, after cutting rates a number of times this year, is likely to hit a pause button. In UK, growth is suffering because of local policies and situation remains grim. Coming to India, Indian economy continues to grow at a very good pace. The first quarter FY26 numbers, the GDP numbers was 7.8% growth rate, which was much in excess of the consensus of around 6.5 to 6.6%. This surprised markets, obviously. On the other hand, inflation is dropping to very, very low levels. We saw a low of 1.6% in July before inflation picked up to 2.1% in August. RBI has been in the pause mode for last two policies, anticipating higher inflation going into 2026. In the last policy, RBI had revised CPI inflation projections from 3.7% to 3.1%. However, they chose to remain in neutral mode and in a pause mode despite the lower inflation prints. They argued that inflation is expected to rise sharply in the first quarter of FY27, and their projection was showing a number at 4.9%. However, these numbers can undergo a change, especially after government cut GST rates recently. The impact of GST could translate into drop of inflation about 0.2 to 0.3% in the upcoming prints. If we look at markets, 10-year yields climbed to a high of 6.65% immediately after the Prime Minister announced GST rate cuts in his speech on the Independence Day. This was despite a rating upgrade from S&P, where global rating of India was upgraded from BBB minus to BBB, which happened after 18 years. So clearly, the GST rate cuts overshadowed a very positive rating upgrade for India. However, when the GST rate cuts were actually announced, the numbers were not so bad and markets recovered. But however, the damage had been done. 10-year now trades between 645 to 650 range and is awaiting policy action from RBI. In a sense, what direction should the market take? The government also announced recently the FY 2026 second half borrowings, which were lower than what was budgeted. So this was also a good surprise for the market because the expectation was that with GST rate cuts and the consequent revenue loss, there could be pressure on the fiscal. And that was the reason when earlier a 10-year rates climbed and other rates also climbed higher. Going forward, there is no cues for the market to move in either direction. Markets may remain lackluster because of one, RBI in pause mode does not give much direction to the markets. Liquidity side has been very good, so short-term bonds continue to remain supported. The only negative seems to be pressure on INR, which is crossed previous high and currently around rupees 88.75 to the dollar, which creates some concerns on the external front. This may be due to the 50% tariff put on India by the US administration. India continues to engage with the US administration on the trade side, but it may be some time before they reach a conclusion because there are some very large ticking points. Markets will await resolution of the situation. Going forward, we expect markets to remain and move sideways. Liquidity is good. There is no pressure on rates because of that. In the current market scenario, duration play is limited. The spread between government bonds and corporate papers are on a higher side after the recent sell-off. This provides opportunity to focus on short-term and medium-term bond funds where there is larger exposure of corporate paper. Investors may choose to focus on funds like short duration funds, corporate bond funds, and banking and PSU debt funds. As usual, investors should look at their investment horizon and their risk appetite before investing in debt funds. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.